Everyone dreams of becoming financially free. But have you ever asked yourself why some people seem to attract wealth while others struggle all their lives? The truth is, the rich don't just make different choices, they think differently. They view money, risk, time, and opportunity in ways that ordinary people overlook. In this video, you'll learn exactly how they do it, not through luck or secret formulas, but through principles anyone can apply. We'll break down what investing truly means, how to start even with little money, and the 8 wealth-building lessons the rich use to multiply their income and protect their future. By the end of this video, you'll see money in a new way, as a silent worker, constantly growing, even when you're not. Investing is not about gambling in the stock market. It's about committing your money or resources today, expecting them to grow and create value tomorrow. The goal is simple: to make your money work while you sleep. If you have to work alongside your money every day, then that's not an investment. That's a job or a business. True investing is passive. You plant a seed once and let time, patience, and compounding do the rest. Think of your money as employees. The more wisely you deploy them, the harder they work and the less you have to. Every investment falls into one of 3 major categories. Understanding these will help you know where to start. First, traditional investments. These include stocks, bonds, and real estate. Stocks represent ownership in a company. When it grows, you earn through rising prices and dividends. Bonds are loans you give to governments or corporations. They pay you back with interest. Real estate involves buying property or land to earn rent or sell for profit later. Second, alternative investments. These are assets outside traditional markets. Cryptocurrencies like Bitcoin or Ethereum. Commodities such as gold, silver, or crude oil. Private equity or startups, investing in early-stage businesses. Third, cash and cash equivalents. These include savings accounts, fixed deposits, and money market funds. Each category has different risk levels and rewards. Stocks may be volatile but can grow fast. Bonds are safer but slower. Real estate offers stability and tangible value. The key is to know your goals and choose a mix that matches your risk tolerance. Each type has different risk, reward, and accessibility. Wealthy investors don't bet on one type, they mix them intelligently. That's where diversification comes in. One of the most powerful rules in investing is diversification. It simply means do not put all your eggs in one basket. Diversification means spreading your investments across different assets, sectors, or even countries. Why? Because no one knows the future. When one investment performs poorly, others can balance it out. Even the Holy Book says, invest in many places, for you do not know what risk lies ahead. Diversification protects your capital, stabilizes your returns, and helps you stay calm when markets swing. There are 3 main types. Asset class diversification means spreading across stocks, crypto, real estate, and bonds. Sector diversification is about investing across different industries like tech, healthcare, or energy. Geographic diversification has to do with investing across different regions or economies. Smart investors don't chase returns, they build balance. That's how wealth survives market storms. The biggest difference between the rich and everyone else is not just what they invest in, it is how they think about money. Most people see money as something to spend or save. The rich see money as a tool or a worker that is being used to build freedom. While the average person asks, how much can I afford right now? The wealthy ask, how much can this investment earn for me later? They operate with a growth mindset. Many of today's millionaires and billionaires didn't inherit wealth. They built it from the ground up by seeing every dollar as potential seed capital for future growth. To them, wealth creation is not about luck, but discipline. They understand that money is energy. If it's idle, it loses value. If it's working, it multiplies. And that's where the journey begins, not with big capital, but with a big mindset. Albert Einstein once called compounding the eighth wonder of the world. Compounding means your earnings start generating more earnings, a snowball effect that grows faster the longer it rolls. For example, if you invest $1,000 and it earns 10% yearly, you'll have $1,100 next year. But the year after, you'll earn interest not just on the original $1,000, but on $1,100. That's $1,210, then $1,331, and so on. The secret? Time and patience. The rich understand that compounding is not a formula, it's a belief system. They resist the urge to cash out during market drops. They let time do the heavy lifting. That's why many invest in long-term equities, index funds, or private equity, assets that reward consistency and endurance. Compounding doesn't just grow your wealth, it rewires your relationship with time. You stop chasing quick profits and start building unstoppable momentum. Every great investor understands one truth. There is no reward without risk. But the difference between smart and reckless investors lies in how they manage it. The wealthy are not afraid of risk. They study it, measure it, and control it. Before they invest, they ask 3 questions. What's the potential downside? What's the potential upside? Can I handle it if it fails? They take calculated risks, not emotional ones. You'll often find them investing in early-stage startups, global real estate, or emerging technologies. But behind every move is research, data, and expert advice. That's how they turn uncertainty into opportunity. For everyday investors, smart risk-taking means this: never invest in what you don't understand. Don't chase hype or trends. Focus on long-term value, not short-term excitement. The rich know that the goal is not to avoid risk, but to manage it wisely. One of the greatest advantages of the wealthy is flexibility. They are not locked into a single idea or market. When conditions change, they adapt. If the stock market becomes overheated, they move some capital into real estate, private debt, or even fine art. When a new opportunity arises, like blockchain or green energy, they explore early but cautiously. Flexibility means staying open-minded, not emotionally attached to one type of investment. The world changes fast, but those who remain flexible ride every wave, while rigid investors sink with the tide. Remember, flexibility is not about reacting to noise, it's about responding to meaningful change. The ultra-wealthy don't think in months or years, they think in decades, sometimes generations. Their investment horizon often stretches beyond their own lifetime. That's why they build family offices, trusts, and tax-efficient structures, not just to grow wealth, but to preserve it. Every decision is guided by one principle: endurance. Markets rise and fall, trends come and go, but time rewards patience. The rich understand that compounding needs space, and space comes from long-term vision. For everyday investors, this means avoid checking your portfolio daily. Focus on consistent growth. Think about where your money will be in 10, 20 years, not 10 days. True wealth is not built in a rush, it is cultivated through time. Even the richest investors face losses, doubts, and fear. But what separates them from the rest is discipline. When the market drops, most people panic. They sell in fear. The rich stay calm. They see corrections as opportunities, not disasters. They review performance, adjust strategy, but never abandon their plan. They also know that emotions are the biggest threat to long-term success. Overconfidence, greed, and fear have destroyed more portfolios than any market crash. That's why the ultra-wealthy surround themselves with advisors who challenge their biases and keep them grounded. For you, emotional control might mean automating investments or simply turning off the news. Remember, patience and perspective always outperform panic. The habits of the ultra-rich are not magic. They're principles anyone can apply. Here's what to take away. 1. Think long-term. Focus on decades, not days. 2. Diversify wisely. Don't rely on one income stream or one market. 3. Let compounding work. Start early and stay patient. 4. Take smart risks. Study before you invest. 5. Stay flexible. Adapt when the world changes. 6. Control your emotions. Don't let fear or greed make decisions for you. Wealth creation isn't reserved for the few. It's built by those who commit to learning, applying, and waiting. Remember, the rich didn't start rich. They started strategically. Wealth isn't built in a day. It's built by discipline, patience, and wisdom. If this video inspired you, hit the like button and subscribe for more lessons on wealth and financial growth. Comment below, which of these 8 lessons spoke to you the most? Until next time, keep learning, keep investing, keep your eyes on the long game. Thank you for watching, and remember, the best investment you can ever make is in yourself.